market doing?
Yeah.
I said, you know what? It's up 200 points. This was right before everybody came to me. He said, oh, really? Why is it up 200 points? I said, are you kidding? I have no idea. Gary, let me turn it over to you here. How are you investing in this crazy volatility? What are you doing?
We're asking me, Maria?
Yes, Gary.
I'm sorry. You know, people have asked me, what are you doing now with your clients? Or, you know, the typical question is, what are you doing now given the current environment? My answer has been the same as it's been before, which is we're doing the same as we did before. And our allocations are, I think, a little bit different because we've always advocated an allocation towards alternative investing, non-correlated vehicles, real assets. One only has to take a look at the way the Harvard and Yale endowments are positioned and the way they've changed their allocation to stocks over the last 5 and 10 years to see, in my opinion, a paradigm shift in an allocation that drives lower volatility and consistent returns. Fact of the matter is, if you're just in equities and you're looking about what equities to buy and you're looking about what equities to sell, whether I should be in, I should be out, what should I do, you're really missing a significant opportunity.
You say that. I'm curious, though, what asset you would point us to. In other words, if you were to look at virtually any asset class, as you know, it's worth less now than it was a couple months ago.
But I would take and I would agree with you, except for the point, why can't I trade both sides of that particular move? You look at oil this year. Oil had a classic reversal rally. It rallied into 147, and then anybody that saw that break and saw it coming off, saw the bubble that took the opposite position, was able to ride oil up and then ride oil down. For the most part, you're going to see situations in 2008 on the real asset side that were a little soft, no matter how you look at it. We've had a perfect storm. There's no two ways about it. But if you look long term, and that's the way investors, we say, should be looking, you can see that assets that are mixed with alternative asset classes, even to an extent real estate, I know it's kind of a bad word these days, but income-producing real estates, the type of REITs that we've been involved with, private REITs, have generated consistent dividends, consistent income, and for the most part have had no price fluctuations.
All right. I want to get up to Asia real quick, and we'll come back to the panel in a second. Oriel Morrison in Sydney, as markets have opened up there. I'm assuming you got a positive kick. I actually know it, having looked at some of the indexes. But Oriel, what's driving it, and how does it compare to recent rallies?
Well, we certainly are seeing a strong rally here, but it's not as much as futures were predicting on the open. I mean, let's start in Japan here. The Nikkei 225 up by 3% on the open at 7,859. Now, we did see this index hit 26-year lows yesterday and then rally by around 6.5%. And futures, as I said, was pointing to around about a 500-point rally on the open. So while we are seeing some strong gains in this particular market, they aren't as strong as what we had expected. This market is really being helped by that speculation that we're hearing around the market that the Bank of Japan may in fact come in and cut rates at its next meeting, which would take the benchmark rate there to around 0.25%. And this has seen a strong rally in the dollar yen. In fact, that cross rate has rallied the best that we've seen in around 34 years. If you take a look at that currency now, we're currently sitting at around 97.83. We were at 93 at this time yesterday, so you can see how much that's rallied. That's going to help the exporter stocks, of course, in Japan, like Sony. That's going to report after the bell tonight. Also, we'll be watching automakers. Now, Honda, of course, cut its profit forecast overnight. That stock, though, is still expected to rally, and, of course, a lot of strength in the Australian and South Korean markets as well. Dylan and Maria.
Oriel, thanks very much. We will continue to watch the developments there and see if that actually indicates where we're going tomorrow. Let me bring Bruce in here. Bruce, we're talking about the Fed meeting and what kind of impact it may have. Let's say we get that half-point cut that everybody's expecting. You think the markets react?
No, I don't think the markets will have a big reaction from it. I think that's well expected. And, you know, the Fed will be, I think, reluctant to guide in any clear way towards any further rate cuts here. So I think the market will take the Fed move in stride. I think what's really important here, and it comes back to something Steve was saying, which is how does all of the actions taken by the Fed and other central banks that are in the pipeline still work towards containing stress. We saw a big increase in commercial paper issuance with the Fed program starting this week. I think that's an important step alongside a number of other things that are coming here. And how we see funding markets behave in the next few weeks, I think, is going to be really important to the tone markets take and also to how well we can track the overall picture on the economy.
Bruce, I want to ask you about your forecast, which I obviously follow closely. You have a very aggressively negative number for the fourth quarter of this year. And if you could explain that, what you think happens to unemployment, and then that in context of where the market is and what kind of recession it's pricing in. Has it already priced in your scenario, or is there has it overpriced it in?
Well, Steve, as you said, we have a very weak couple of quarters here. 4% down this quarter, 2% down the next quarter. We do not, though, have the recession continuing well into the the latter part of 2009. So we have a very sharp event now. I think we're seeing the credit event interact with the weakness in the economy even before the latest stresses hit. And we're seeing consumers, I think, take a step back. The confidence reading today, I think, is a good indication of that. And we'll see auto sales, I think, take a big dive.
In talking to a whole string of asset managers, Bruce, most recently Karen Feinerman and the rest of the traders even this evening on Fast Money, their argument is if you can give me one statistic over the next year, the one I would want to know is what will happen to employment. And if you could answer me that question, Steve, I want to hear your answer to this as well. I could give you an entire investment thesis if you would tell me what's going to happen with unemployment. And I'm curious, Bruce, Steve, and anybody else, how confident any of you are in your ability to actually forecast that. Bruce, why don't you go first?
Well, I think the employment picture is going to be pretty weak here. We'd say somewhere around minus 200,000 for the next few months. If you ask me to take one variable, I'll take jobless claims. If jobless claims stay around 500,000, don't break above this in the next few months, I think we're containing this to be a normal recession dynamic. That's not good news. But I think with what's coming down the pike on policy, we'll start to see ourselves come out of it late spring, summer. And I think that will begin to be reflected in the markets as we get into year end.
I think that's a backwards way of going about it, Dylan. I would not want to know the unemployment rate as the single most important factor, because I think what's going to happen is the economy is going to recover well before the jobs market recovers. And the single most important factor that I'd want to know is what productivity is going to be in this country, and that is kind of a proxy for saying in the downturn and throughout the downturn, can companies retain profit margin and operating leverage. And that's really the key. When you want to know what companies are going to be able to profit in this environment, can they still put out widgets profitably when revenue and widgets numbers decline?
But if what I'm trying to calculate ultimately is a potential default rate and a whole basket of vulnerable assets over the next 24 months, is not the potential for that default hugely dictated by how many people get fired or lose their jobs in that time period?
No, because if you get to, if we can get back on the curve, and I think this is really critical.
Mean?
Well, we were so far, like when you talk about the consumer confidence number today, it is without precedent. There is no thing even close to it. 38. I mean, whatever the number was. If we can get back on, if you can get me to a 40 or a 40 or something, so a 45, get me back on the curve. Tell me where I am in the business cycle. Get me on the normal credit cycle. I can start to price in on the relationship of unemployment to foreclosures, and I can forecast that. That is what everybody in this market. The reason why we have these 10 up percent, 10 down percent swings, because we cannot price in the uncertainty. Get me on the curve,
as long as we have 8
and I can
and
give
9
you a
standard
price.
Deviation events.
Right, exactly.
You can't do anything.
Exactly.
You need
can I just ask Bruce's comment on that?
Very
that's
quickly,
the right way of thinking about things.
I guess,
Bruce, go ahead on that. Is that what we're hoping for, is to get back on the curve here?
I would say we need to see three things happen in sequence. First is containment of the crisis in the funding markets. That's by far the most important precondition for anything good to happen. The second thing we need to see is cushions. Cushions come with falling oil prices. They come with falling mortgage rates. They come in with Fed ease and fiscal stimulus. In the next 4 months, that's what you're going to see with bad data. And then if we get that, we start to get confidence coming back, and we begin to see growth pick up.
A pleasure. Thanks to you all. Here's to getting back on the curve, Steve.
Back on the curve.
Let's raise a glass tonight.
The bottom is in.
Up next, the political interview of the day. I am proud to say my partner on the closing bell, and the woman. I won't go on about you, Maria, but it was well deserved that you got the interview, and you did a great job.